everybody, and thank you for joining us today for our Executive Series webinar on our Part 2 to the 900 Billion Stimulus Employee Retention Program. And also thanks to those of you that are joining us on Facebook Live today. I am Jen Gaudioso, VP of Member Advocacy here at Inspire Care 360, and happy to be taking Tony's place. And he does send his apologies on not being able to be on the call due to a personal commitment. You may see his picture on there with Leah, our marketing director's name on there. I assure you, Tony is not on the call. We just hacked into his account. And I'm also safe to say you are in better hands with me on here. We are happy to welcome back our friends from RDG, Dan and John, and I will have them introduce themselves in a couple minutes. But at first, I want to do a couple quick housekeeping items and go through our agenda. So with our welcome, you'll notice on your screen that there is a Q&A function. If you have any questions to ask throughout our webinar, please use the Q&A function and not the chat function. This will allow Dan and John to answer and address any questions throughout the webinar. And also at the end of this, we will be sending out a replay, and you will also be able to obtain a certificate for participating. Moving on to a couple of our housekeeping notes that I want to touch base on. Our next webinar will be February 8th, so be sure to watch for more details to follow on that. We'll also talk a little bit about our Healthy Advantage and our very own friends from our ECE financial experts, John and Dan. So most of you have probably joined us in the past for our webinar and have seen that we have rolled out our IC360 ECE Healthy Advantage. This is something that we have been working on for the past couple of years and are very proud to be able to roll this out to everybody in our industry. It's taking off wonderfully with our members. It's an affordable healthcare package that you can offer your staff. As you know, it's one of our biggest challenges within our industry. And not only is it affordable, but it also meets the Affordable Care Act. Part of it is the flexibility of the programs. There's 5 program options for you to be able to choose from and for your staff to choose from. It's easily implemented by working with our team here at IC360 and the enrollment specialist. You have access to an online app and customer service. And with some of the programs that are available, they're available to your staff at $1. There's no high deductibles. There's co-pays for office visits, for specialist visits. And then we also have the ECE with their staff friendly. We speak our language. Our benefit counselors will call your staff to help educate them on the policies that we are offering and the coverage. And that was one of the biggest things that we have learned through all of this, that education is key to the policies, so your staff are familiar as to what they're being offered and what they're enrolling in. And with that too, as part of Inspire Care 360, we have a learning management system that you are able to administer that course to your staff to educate them so they understand the different values and the different benefits through Healthy Advantage. So, and with that, we have currently 20 ECE companies have joined. So we're super excited that they're able to roll this out and offer this package to their staff members. And just a little side note, and I can speak to this as I do a lot of the enrollment with our members, it does take about 1.5 to 2 months runway to have your team set up. And that's just from start to finish of making sure the paperwork is solidified, that your benefit counselors are set up to call your staff to have those one-on-one conversations with them, so you're ready to have your rollout on your effective date. So if you would like any further information, do not hesitate to reach out to us at benefits@inspirecare360.com, and one of our team members can help you, show you a demonstration of the program and the platform that we use. Moving on to our IC360 EC Financial Experts. This is also a program that we have rolled out with our partners, RD&G. We're able to offer our members a program outline and review their financial statements, put it into a roadmap as to see where they're doing well, where they might need a little help, and then they meet one-on-one with our partners, with either Dan or Rob, and we're able to get them to the area that they really need to focus on when it comes to your business. They are able to give you the KPI indicators for your business. And like I mentioned, green, you're doing great. Yellow, you might need a little help. And red is an area you'd really like to focus on. And with that being said, also, we've had new companies that have joined our financial experts, and they are working side by side with them. And we will do that free assessment for our members that are interested in advancing into that area of our solution. And at any time, you can always reach us at benefits@inspirecare360.com to learn more about it. With all of that said, I am going to open it back up to Dan and John from RDG and Partners as our guests today, so we can roll into part 2 of the 900 billion stimulus package and the employee retention credit. Dan and John, welcome back.
Awesome. Thanks, Jen. Glad to be here. All right. So good to be back with you guys as always. And I'm just going to share my screen here so we can get into this new stimulus program. So today we're talking about employee retention tax credit, part of this Stay Strong webinar series that we've been putting on. So we're excited to talk to you guys about this today. So I wanted to just say, again, thanks everyone for attending. Welcome. Hope everyone's staying safe and healthy. It's the most important thing right now. Looking forward to these vaccines rolling out so we can get back to normal. And big thanks to our team. So it's more than just our research team too. We've got everyone behind the scenes helping to answer questions today. We've got Rob, who you'll see his name as he's answering these questions. So as you're putting them in, you might see Rob. He's going to answer them throughout the presentation. Anything he can't get to, we'll get to either live during the presentation or we've got some time allotted at the end. So thanks to him. Thanks to our design staff for putting these awesome slides together, Crescendo. Then we've got Linkware, who's been helping us on the technology side so we can get all these ERC credits processed as efficiently as possible. And we'll show you a little bit of that cool tech later in the presentation today. So thanks, everybody. You've got John and myself, Dan. As always, we have Rob in the background. So we've got a team here today with you guys presenting again. So our agenda, we're going to go through some news. What's the latest news? We'll touch on a couple things, not just ERC today, because there's a lot of stimulus out there. So we'll go through all the things that have happened in the last couple of weeks. We'll go through this employee retention credit, which is huge. We'll give you some insight on some strategies to use, and not just about the credit. We want to tell you about some strategies and how you can really maximize the impact, and then we'll have time allotted for Q&A. So news review, what do we got going on? Well, we've talked about this in a couple webinars that we've done for you guys. PPPL taxability, that was the huge issue. Was this taxable or was it not? So we knew the income wasn't taxable, but then we had all these IRS threw a wrench in the system, said the expenses aren't deductible. The last webinar we were on, we told you, hey, expenses are now deductible at the federal level. So we're here to also say that a lot of states are starting to agree. So the big news is, for example, in our home state of New York State, they agree that expenses shouldn't be deductible either. So they're conforming with the IRS, and PPP is fully tax-free. The expenses are deductible, and it's a nice little tax-free gift. So that was huge. That came out recently. A couple things about ERC, about PPP, EIDL. So the SBA and the Treasury defined gross receipts. This has been we've been getting a lot of questions on this from our clients. And so it says in the guidance, gross receipts is total income plus cost of goods sold. And people are like, oh, that must mean that's my sales plus my cost of goods sold. And that just doesn't make any sense. And that's because what the IRS is referring to and the SBA is referring to is a tax return. So a typical tax return, if you haven't looked at your page 1 of it in a while, is you start with your sales, you reduce it by cost of goods sold, you reduce it by some of these other gains, and you get to what the IRS calls total income. So to get back to gross receipts, which is sales, you have to add back cost of goods sold. So the long story short is when we're talking about a decline in gross receipts, so we're going to talk about that today, they really just mean sales. Keep it simple. Gross receipts means sales. All right, so some more news. They came out with a simplified forgiveness application if your loan is under 150. So if you remember, they had originally, if you didn't lay anybody off, they came out with this EZ application. Then they came out with an S application, which was if your loan was under 50. Now they've got an even easier application as long as your loan was under $150,000. for PPP. So your PPP forgiveness application, if it was under 150, they've made the forgiveness process really easy. And as we'll talk about later, you want to be real careful before you apply for forgiveness because you want to coordinate with the ERC. We're going to talk about that today. Talking about in PPP land, you need to have a 25% revenue decline in order to qualify for PPP2. So if they clarified the guidance on what period you could use, so that was the big news there. They talked about documentation. So if your loan is under 150, not only do you have an easier forgiveness application, but when you're applying for PPP2, you also don't have to supply as much documentation to your bank when you're applying for that loan. So if your loan's under 150, you really don't have to supply P&Ls, tax returns, bank statements, any of that. But it's just going to be easier, and a lot of banks are actually requiring it just to have it for later, to supply it now. So our recommendation is get your ducks in order now, and then you have it for later and make this whole process pretty easy. And then Biden released with his inauguration his American Rescue Plan. A lot of that, you'll notice that this administration is focused on individuals as opposed to the businesses. So a lot of this American Rescue Plan, the next $1.9 trillion, is focused on getting stimulus payments up to $2,000, increasing the child care credit on your individual return, and the child tax credit. So a couple of things there. And then more updates to come. So news is coming out every day, clarifications, new options, new techniques. So I'm sure there's going to be a lot more news in the coming days. So usually I go onto Twitter here and go through all of the things that have been going on there, but they suspended me, and so I got cut off from Twitter. One more person bit the dust. That's me. So anyways, I took a screenshot on my phone before I got shut down. There really hasn't been a lot of press on the ERC, but it's a big deal. So I grabbed the two screenshots I could find on this thing, but this is big, for a lot of businesses, especially in the child care industry with revenue declines. So this is why we're here today. All right, so retention credit details. I'm going to go over some of this, give a little overview. John's going to chime in on some of the observations here, but I just want to give you kind of a high-level overview of what this even is that we're talking about. So it's called the Employee Retention Credit, ERC. So just like the Paycheck Protection Program, PPP, now we've got the ERC. And they're very similar. So both of these programs were designed to keep people on payroll. That's the whole intent. So that where the PPP, you apply through your bank, it's basically money that the government gives you. This you do on your payroll tax returns. Your payroll provider would be helping you submit this tax credit. We'll get to how you calculate it in a little bit. So I actually looked up PPP, $600+ billion that they allocated to that program. They're only estimating, the CBO, that this will be worth $10 billion. We think it's going to be huge. This could be really big for businesses, especially those that are impacted. So that's kind of just high level of the employee retention credit. So the eligibility requirements for the credit. So you either have to have one of two things. You either have to be fully or partially shut down because of COVID, and it's through a government order. So like if you're in New York and Cuomo shut down New York State and you were suspended, that would be one test. Or in 2020, your sales, so it says gross receipts, but again, we just talked about it, your sales need to be less than 50% compared to 2019. So if your Q2, that's when a lot of people were impacted, Q2 of 2020 was 50% less than 2019 Q2, you would qualify for this tax credit for that quarter. Now, that was the 2020 credit. They expanded this in 2021 and said you only have to be down 20% in revenue for the quarter, same quarter of 2021, so Q2 2021 to Q2 2019. If you're down 20% over that period, you would qualify, or if you were fully or partially suspended. So that's how you qualify for this credit. So John, you want to give us a little observation on that?
Yeah, so basically, like based on the new reduction, there should be a significant increase in eligible businesses. So you have time to plan because Q1 isn't over with yet for this year, obviously, and then you'll have Q2. So if you have any control over your gross receipts /sales, this is an opportunity. If you're only down 20%, That's such a big difference from 50% from last year. So you actually have somewhat of control over this right now, and if you're can be eligible for this credit.
That's right. And it definitely applies to those centers that are still ramping back up and trying to get kids in there with capacity limits, et cetera. So you want to keep an eye on this and definitely plan for how to capture this credit. So eligibility based on size. So any company is eligible for this credit. However, there are limits, and it determines how much of the credit you can actually get. So in 2020, if you had 100 or more people, you qualified for the credit, but you only get the credit if, for example, if you were shut down for 3 days, you'd only get the credit for the people you paid that were laid off for those 3 days and that you paid them. So you had to have paid them if you were over 100 employees in order to get this credit. If you were under 100 employees in 2020 and a couple employees were out of work because your center was shut down, all of the wages across your company would be eligible for this credit. So if you had 5 people that had to go home because they were non-essential workers, and that's how the government said those people got to go home, then you would qualify. If your sales were down by 50% and you were under 100 employees for that entire quarter, all of the wages paid would be eligible for this credit. That was 2020. Under 2021 credit rules, that has been expanded. So as long as you're under 500 employees, then all of the wages paid during the quarter would be eligible for the credit if you were shut down or had a significant decline in revenue. So they've expanded it and made it available to larger companies.
So Dan, I have a question in regards to when owners, obviously this will apply for a lot of our members and everybody that's on the call today with the multiple centers. Does their entire group of companies with common ownership have to qualify for the revenue drop as one group, or can some centers qualify that are in separate legal entities? And other sites where revenue bounced back not qualify? Like, how would they go about that?
Yeah, it's a good question. So I'll kick that actually to Rob, who's on our research team here. You can answer that question.
Hi, Jen. Great question. So when you have multiple locations, if you have one location that was shut down, then your company qualifies for a partial shutdown. And based on your employee size, based on the number of employees, then you can take the credit for those employees that were either paid while they were shut down, or if you're less than 100, then everyone qualifies.
Yep. And so, Jen, just to clarify too on the point is, like, if you have separate legal entities, which I know a lot of your members have, right? So they might have a couple different companies set up with, for legal purposes, then you have to aggregate the employees across all of the entities that have common ownership.
Okay, thank you.
All right, so under the old rules, if you had the reason that this wasn't so popular is because everyone received a PPP loan. So under the old rules, if you had a PPP loan, you couldn't qualify for the employee retention credit. Now you can. So they updated the rules and said, yep, that's okay. Even if you got a PPP loan, you're still eligible for the ERC. And that applies for both 2020 and 2021. So now, whether you got PPP or not, you qualify for ERC. All right, so maximum credit amount. For 2020, it's different than 2021. So in 2020, the credit was 50% of wages up to $10,000 per employee, meaning 10,000 wages times 50% gives you a $5,000 credit. That $5,000 was per employee for all of 2020. So the maximum credit you could get was $5,000 per employee for all of 2020. In 2021, not only is it easier to get this credit because you only need a 20% decline in revenue and you can be under 500 employees for all the wages, but you also get 70% of the qualified wages. So $10,000 of qualified wages times 70% equals a $7,000 credit per employee. And you can take that $7,000 credit in both Q1 and Q2, meaning you could get up to $14,000 per employee for 2021, and you could get a $5,000 credit for 2020. So you could get $19,000 for for your employees for 2020 and 2021. All right, so going back to this example, so the maximum wages that you can have for any employee is $10,000. So to calculate the credit, pretty simple math, take 70%, which is the credit rate, times your up to $10,000 in wages, and you can get a $7,000 credit. So pretty simple math. You just have to focus on whether or not you qualify for this credit. All right, so how do you capture the credit? So first is determine if you're eligible. So we went through these eligibility requirements, and did you have a 50% or a 20% sales decline? And that's 50% is 2020, 20% is 2021. Or, it's not and, this is an or, were you temporarily or permanently shut down? So if you were shut down for a month, you potentially qualify. Then step 2 is calculate it. So you calculate using your payroll reports, using the dates that you were shut down due to a government order. And then you have to coordinate with PPP, because while I said you could have a PPP and an ERC, the important thing is you can't double dip. And John's going to go into a strategy in a little bit about how to successfully use the PPP and the ERC together. So reduce the ERC credit and the wages by any amounts that were reimbursed by PPP funds. Once you've calculated your credit, you work with your payroll provider to either file a 941 for quarter 4 of 20, or if you've already filed your fourth quarter 941, which a lot of you probably have, they would file a 941X, which is an amendment to the 941. That's for 2020. And then in 2021, going forward, you would either take this credit on your normally filed 941, or you would file for the advanced payment credit, which we'll get into as well in a second. So advanced payments. So before in 2020, there was no way for you to monetize the credit before you actually filed your 941. There still isn't a mechanism, but it's on the way. So the Treasury Department is drafting regulations and guidance that's going to allow for an advanced payment of this credit. So if you think your sales are going to be down in 2021 compared to 2019, you have the opportunity now to apply for this credit in advance as soon as these regulations are finalized. So be on the lookout for that. That's why a lot of planning could go into whether or not you should take this credit now or later.
Hey, Dan, a
All right,
question
so I'm
come
gonna
through in the chat is, how do they determine partial shutdown?
Yeah. So if the government said, hey, you're deemed non-essential, or for your childcare business, you've got to be shut down, then that would qualify. So you have to be it has to be like a government order. Somebody has to tell you that you can't have your business open the same way it was before from a government agency.
Yeah, Jen, we could actually, the IRS actually has a link with frequently asked questions that relate just to shutdown. There's over 30 of them, like 30 different scenarios that you can review. We could send that link out after the webinar so everyone can see it. But basically, if there's any sort of governmental shutdown where they're not requiring your employees to be there, or the kids can't be there for whatever reason, or the kids have to stay home because their parents aren't working, it's not overly difficult to show at least a temporary shutdown. But the best benefit here, or the best way to capture the credit, is if you actually decline 50% or more. Then you don't have to worry about shutdowns. So you really have to start by reviewing your numbers.
Cool. All right. So, John, why don't you give us some strategies?
Yeah, so like anything, I mean, the first thing I would say is that there's a lot of money out there, right? So the PPP 1 was $650 billion. They couldn't even use it all. PPP 2 is another $250 billion, and they're using it, but nowhere near at the pace of PPP 1. And now we have another $10 billion for this, for the ERC credit. So, and that's why this one isn't talked about as much, but we just had a client that got more in the ERC than they did for the PPP. So it's significant, and really should look into it, especially now you can actually obtain this credit even if you did receive a PPP loan. So what are the strategies? Well, since you can't use the same costs for this if you receive the PPP, you want to start when you're applying for loan forgiveness, which I'm guessing a lot of you have already done that with PPP1, use as many of the non-payroll costs as possible. So those other costs like rent, utilities, and mortgage debt payments, and now the new costs that you have with cloud computing costs and PPE-related costs, all the worker protection stuff. So you want to start by using the non-payroll costs, because the payroll costs, if you're using them for PPP, you can't use them for the ERC. The next thing is paying bonuses, right? So pay employee bonuses, use the PPP money for that, and then apply for the credit, right? So now you've used that money first, you've already used it for PPP, now you have standard payroll that you can use. The other thing I would say is you want to make sure you're paying payroll. We have a lot of clients where the owner, which may be you on the call here, you're on the payroll, but maybe you only take one paycheck a year. So what you want to do is make sure you're at least paying yourself $10,000 per quarter, so that when you do this calculation, you'll receive 70% of the $10,000 for this year. This is more talking about this year's strategy. If you haven't applied for loan forgiveness for last year, some of these would apply as well. You want to use more of the non-payroll costs. Now remember, this original strategy here with PPP forgiveness was, let's take this as far out to the 24 weeks and use it all on payroll. That's what we were telling our clients until the ERC rules got changed. Now we're saying use as little as possible, use the 60% you need to for payroll, and then take advantage of the other 40% for the other things. And then consider retroactively applying and delaying your forgiveness to use these costs. So again, if you haven't applied for forgiveness yet, you may want to wait and change your strategy now that the ERC is in play. All right, so here's an example that we're going to go through quick. And this is there is a new rule about using the immediately preceding quarter that kind of came out. We want to just cover that. So company B wants to determine whether they can use the gross receipts test to satisfy, right? We want to see if we're down enough. The ERTC eligibility is regard to qualified wages paid to employees in 2021, so that would apply to now. Company B can choose to compare the first quarter of this year, which ends at the end of March, those gross receipts, once you have them, right, to the gross receipts from the first quarter of 2019, right? So it doesn't have to be 2020. It doesn't have to be 2021 compared to 2020. It can be 2021 Q1 compared to 2019 Q1. And the reason is that's when that was pre-COVID, right, 2019. So the other option is company B can instead use the gross receipts from the fourth quarter of 2020, right? So this is where using the previous quarter rule kicks in, and compare those gross receipts to the gross receipts to the fourth quarter of 2019, right? So you have additional option here. If either of those tests shows a more than 20% decline, then you're eligible for the 70% of wages credit here in the first quarter of this year. I know that's a lot and it's confusing, and that's why we're here to help you. But there are strategies like this one that are important that we can help you with when you're deciding. If you look at 2020 calendar quarters compared to 2019 and you're not seeing a decline of 50% or more, then you want to next look at this. Look at this Q4 of 2020 compared to the previous quarter and see if you can meet the 20% test instead of the 50% test. All right, so like I said, it's complicated, and in the dental world, it's kind of the difference between a tooth cleaning and maybe a root canal. It gets more complicated now when you get into these different sorts of things.
That's right. All right, so to help with calculating this credit, we've kind of come up with our team over at Linkware, come up with a form that we can basically just fill out and see if we qualify. So we're going to go through this form and see if we qualify. So John's going to walk us through.
Yeah, so let me give Dan some assumptions here, and we can also send this out. We've been working with our clients, and Rob's done a great job behind the scenes, just helping our clients determine if they qualify. Like I said, it's complicated, and this questionnaire is going to let you know, and our team will respond to you once we receive it, if we feel you qualify for this credit or not. So we put in your organization name, so let's put in the hustle firm there, and then the individual's name. So we'll put Rob Spatola. We'll give Rob a little press here behind the scenes. Rob the man Spatola. And we'll put in, then put in your email address and phone number here. So when this all goes in, it essentially alerts our team that we have a questionnaire coming in. So first question, did the operation of your business suspend fully or partially during a calendar quarter? We're going to say yes. The governor required us to shut down during a quarter this year. Which quarters were we shut down? We were actually shut down in Q2 and Q4 of 2020. Did we receive a PPP loan? Yes, we did. How much was our PPP loan? Our PPP loan was $150,000. And yes, we applied for forgiveness already. Has our forgiveness been approved? Yes, our forgiveness has already been approved. So we've already applied, received our PPP, used the money, and received approval from our bank for forgiveness. Now the gross receipts test. Q1 of 2019, we had $100,000 in gross receipts. Q2, we had $150,000. Q3, we had $200,000. And Q4, we went back down to $150,000. So we had $600,000 in total gross receipts. The following year, Q1, we had $100,000 in gross receipts again. Q2, we dropped to $50,000. COVID started to hit and really affected our business. Q3, we got back up to $100,000. And then Q4, our business was getting back and we're at $150,000 again. And number of employees, 10 employees. And our payroll provider is RDG Payroll. And we do pay health insurance for our employees. So basically, you fill in all this information. You're going to need, your financials in order to do this, and some of your payroll information. It doesn't need to be exact. It just gives us an idea if you qualify. So as you see, when you submit it, you receive a message that says, based on the information you've entered, it appears you may qualify. So this questionnaire is really smart, and they know right away if you may qualify or not. And it gets to our back office here, which Rob is running, and someone will reach out to you as the next steps and how we can help you capture this credit.
All right, so click back to our PowerPoint here. All right, so that's kind of it. That's the employee retention credit. So a lot thrown at you with this one. Again, a little more difficult with the nuances of, was I shut down, was I not? Did I have a decline in revenue, did I not? How do I coordinate with PPP? And then how do I plan for the future with advanced payments of the ERC? So a lot here. So we wanted to take the opportunity. I know we've been answering a bunch of questions in the Q&A. I'm taking those. So we've got time for a little bit more if you guys want to answer those. But I think in general, the point is the government wants to get this money in people's hands, especially the ones that were affected. And if I know anything working with the childcare industry is that you guys were affected. So it's important that you take advantage of all these different types of credits and stimulus programs that they have out there. So we've talked about in the past the EIDL, we've talked about the PPP, the EIDL Advance, we've talked about tax credits and incentives. So qualified improvement property, NOL deductions, business income percentages. So we've taken all these different items and we want you to get every single one of them. So we have a question here from somebody that says, hey, do the changes from the 20% decline are for 2021 only, or can we go back and take advantage of 2020 also? So the answer to that is, again, the credit percentage went from 50% of gross wages in 2020, or 50% revenue reduction in 2020. You only need a 20% in 2021. If you didn't take advantage of the credit in 2020, just go back to 2020. If you had a 50% decline, you can grab that credit. If you didn't have a 50% decline in 2020, doesn't mean that you're out of luck. As John went over with the strategy, you can use that preceding quarter test, and you still might be able to be down 20% in Q4 of 20 compared to 19 and qualify for the 2021 credit. So lots of different strategies there. You're not out of luck. You can always go back and file that 941X.
Yeah, and there's a question here coming through the chat. Are we eligible for ERC only for the quarters where the revenue was less? Yes, you are. So it depends what you're looking at too. So if you're looking at the credit for 2020 where it's capped at $5,000 per employee, if you hit that $5,000 for the one quarter you may be down, then you're fine. If you only hit $3,000 or $4,000 for certain employees, you're still eligible for additional monies for those employees, but you also do have to show that you were down in more than just that one quarter.
Yep. This question comes in from our friends over at Countryside, Lori and John. So they said, hey, we forgot to say that we did not pay the employees during the shutdown. Everyone collected state unemployment. So if that's the case, depending on the number of employees you have, if you didn't pay anybody during the shutdown, everyone was collecting unemployment, you've got to go to that second test. Was your revenue down 50%? If you were shut down and didn't pay people and your revenue was not declined by 50% or more, then you don't qualify for ERC. Not all is lost though, because as you're ramping up, you could qualify for the credit in 2021. So, again, lots of strategies and we can go through that with you.
Yeah, and there's just a question or a request on, can we email the assistance form for reference? Yes, absolutely. We'll send that to Jen, and Jen will get that out to everybody that's on the call today.
All right, so I've got one more question and I'll throw to Rob, because we've been getting this question a lot, is when you have, you've gotten a PPP loan and you've got an ERC, and again, this is kind of coming up, we touched on it before, but do you want to coordinate between PPP, one, forgiveness, and ERC? And if that's the case, how do you prorate those wages that you paid with payroll, and how do you use those non-payroll costs?
Great question, Dan. So you definitely want to coordinate between loan one forgiveness, and you want to use up to 40% of non-payroll costs for loan one forgiveness. And then the coordination with the ERC is that you cannot double dip, right? So you can't use payroll costs that you use PPP loan one for. So you want to coordinate there, run calculations, and make sure that you're not double dipping. So the $10,000 per employee cap can't be used for both.
So Rob, I have a question for you in regards to that with the double dipping. How would you, one of the questions I know I get from our members a lot is to be able to understand how to fit all the pieces together. From original PPP, the 2020 ERC, the PPP2, the 2021 ERC, how do you fit all of that together?
Right. So the PPP2, you can only apply for that if you're eligible, number one, and if you've taken loan one. So if you never took loan one, you're not eligible for loan two. As far as the ERC, if you have not applied for forgiveness of loan one, then you would look at the ERC when you qualified. So when you were partially shut down, and or the quarters that you saw a revenue drop of 50%. So we would look at the payroll detail for those specific time periods and then coordinate that back with loan one forgiveness.
Awesome. All right. So then we got another question in here. Is PPP considered sales when figuring out total gross receipts? And the answer to that is no. So they came out with clarifying guidance that says PPP is not considered income. So you cannot consider that when looking at the decline in revenue.
There's another question here on quarters from Tammy. So the test has to be done for each quarter separately to determine eligibility for each quarter. Or if you qualify for one quarter, can you use the whole year? No, it's quarter by quarter. So if you qualify in a certain quarter, you take the wages of that quarter only. So hopefully if you spent at least $10,000 in payroll for each employee, then you'd be fine. If you didn't, then you look at it again in another quarter where maybe you've declined.
All right, and then we got another question coming in here that said we didn't have any revenue during the shutdown. Yeah, and that plays into it. So you might have had no revenue and didn't pay anybody during that quarter, but maybe that shutdown was only for a month and a half. And because of that month and a half shutdown, that means if you looked at that quarter, let's just say it was quarter 2, because of that shutdown, receiving no revenue, you were down 50% for that quarter compared to 2019. Then any of the wages you paid for the remainder of the quarter, the second month and a half, would qualify for ERC. So you got to look at it from both sides. So, all right. Well, everybody, again, we appreciate being invited here to you guys. If you have any more questions, definitely filter them through Jen and her team. They'll make sure that they get over to us, and then our whole office will be looking at those. We'll send out that link so you guys can calculate whether you qualify or not. It's pretty easy, as you saw. And if we can be of any further help, we just want to remind everybody to stay strong, and thanks for joining us today.
Thanks, Dan,
And
John,
thank
and
you.
Rob for
Thank you.
being our guests yet again. And like Dan just mentioned, if you guys have any questions, feel free to send them to the benefits at Inspire Care 360, or if you guys have my contact information, feel free to reach out to me directly and I can pass those questions on. We will be sending a recap of today's webinar, so watch for that in your email boxes and that's when I'll put in the link too that RDG is going to send over to us. So thanks everybody for joining us. We will talk to you all soon.